Foresight Autonomous Holdings, Buffett-Style Investment Analysis 1. Business Quality and Moat. What they do business model? Foresight Autonomous develops 3D perception and machine vision systems for automotive, drones, rail, and other safety-critical environments. Their portfolio includes stereoscopic cameras, sensor fusion, and image processing tools designed to enhance autonomous driving and advanced driver assistance systems ADAS. The company sells to OEMs, Tier 1 suppliers, and integrators, while also pursuing defense and public transit safety applications. Competitive advantages, potential moat, proprietary technology and patents. Foresight holds intellectual property in stereoscopic vision, multispectral imaging, and quad camera setups. Their technology emphasizes reducing false alerts in poor lighting or bad weather. Niche specialization. Many vision systems degrade in fog, glare, or darkness. Foresight's technology is built to maintain performance in these harsh conditions, which could differentiate them in the market. Regulatory tailwinds. Governments around the world are tightening safety standards and pushing for ADAS adoption, creating a growing market for perception systems. Weaknesses. The company has yet to prove its moat with significant revenue or scale. Competition is fierce, with giants like Tesla and Waymo investing heavily in perception systems. Technology risk remains high, as sensor integration and cost efficiency could undermine their advantages. Verdict on moat. Foresight's moat is more potential than durable. The technology could carve out a defensible niche, but it is still unproven at scale. 2. Management quality, leadership, credibility. Management has shown technical competence by progressing through proof of concepts and forming partnerships in transit and drone markets. Capital allocation so far. Capital allocation is weak. The company consistently burns cash and has little margin for error. Without turning research into revenue, continued dilution is a risk. Shareholder alignment. There is no history of dividends, and equity raises appear likely. Unless insiders maintain strong ownership stakes, alignment with shareholders is questionable. 3. Financial strength. Foresight's financials are its biggest weakness. Revenue, around $450,000 in the past year, which is negligible for a company with global ambitions. Margins. Gross margin is over 50%, but operating and net margins are deeply negative. With annual losses of roughly $12 to $13 million, ROE and ROIC both are strongly negative. Current operations destroy shareholder value rather than create it. Cash flow, operating and free cash flow are both about $11 million, meaning the company consumes cash rather than generates it. Debt. Minimal debt is the one bright spot. The company isn't burdened with interest costs, but this is only comforting if they can raise equity before the cash runs out. Cash position. Roughly $6 million in cash is not a large enough cushion given current burn rates. Conclusion. Financial strength is extremely poor. Low debt helps, but the ongoing cash burn and lack of meaningful revenue put the company in a fragile position. 4. Intrinsic value. Using Buffett's approach here is difficult because there are no consistent earnings to measure. Still, we can model a speculative scenario. Suppose by 2028 the company reaches $20 million in annual revenue with modest 5% free cash flow margins. If growth then compounds at 30% for several years before slowing to 10%, the present value of those cash flows might be $5 to $15 million under a higher risk discount rate. Foresight's market cap is already in that ballpark. That means the market is essentially pricing in hope, not proven performance. If the company executes well, it could be undervalued. If execution falters, intrinsic value is close to zero. Verdict. There is little margin of safety here. Buying this stock is closer to venture capital speculation than value investing. 5. Long-term prospects. Opportunities. Strong demand for ADAS and safety systems worldwide. Potential adoption in drones, rail, and defense markets where big players may not focus. Partnerships with Tier 1 suppliers that could eventually bring recurring revenue. Risks. Continued cash burn without scale. Fierce competition from much larger, better-funded players. Risk of technological obsolescence if rivals leapfrog their system performance. Dependence on external financing to survive. Can it compound capital over 10 plus years? Only if the company transitions from research to reliable revenues quickly and secures long-term contracts. That is a tall order. 6. Final verdict. Buffett test criterion pass. Fail reason, understandable business maybe, concept is clear. But execution details are complex. Consistent earnings fail loss-making with no profitability in sight. Goudreau, ROIC fails strongly, negative returns. Low debt past debt is minimal. Attractive valuation, maybe potential upside exists, but valuation is speculative. Durable moat, maybe technology advantage is possible, but not yet proven. Final word. Foresight is not a Buffett-style stock today. It lacks consistent earnings, positive returns, and a proven moat. For Buffett, this would be a too hard pile case until the business shows real cash generation. Right now, the investment looks more like a speculative bet on future adoption than a value play. Hooks for audience engagement. Can a microcap disrupt giants like Tesla by focusing on safety in extreme conditions? Why Foresight's greatest challenge isn't technology, it's surviving its cash burn. Is this stock a future safety powerhouse? Or just another tech mirage, Buffett would say. Show me the money. Can Foresight ever deliver it?